Welcome back to the Daily Earnings Reports podcast. Don't forget to hit that like button and subscribe to stay updated wherever you're tuning in from. Today, we'll be doing a deep dive into Capital One's fourth quarter 2024 earnings.
And we've got some great source material to work with.
Oh, yeah?
We've got both their official press release and their detailed financial supplement.
So we're going to uncover some really fascinating insights into Capital One's performance, their plans, what they're thinking about the future, and maybe even glean some clues about the economy as a whole.
These documents are more than just numbers. They give us a look into Capital One's strategy, their assessment of the current economic situation, and even hints about where they see the financial industry heading.
Okay, so let's jump right in.
Let's do it.
The press release announces a net income of $1.1 billion for Q4. That translates to $2.67 per share.
Right.
Now, I know $1 billion sounds like winning the lottery, but how does this profit actually compare to past quarters?
Yeah, that's a great question.
What about their competitors? Are they exceeding expectations, or is this a sign of something else?
Well, while $1.1 billion is definitely a big number, it's really important to think about it in context. If you compare it to the previous quarter, we're actually seeing a decrease in net income.
Okay, so the question is, why the dip? Is this just a temporary thing, or is there something bigger going on?
Yeah, that's what we need to figure out.
All right, let's dig into the details and see if we can find some answers. The financial supplement breaks down Capital One's performance across their different business segments. One that stood out to me is the credit card business, where they mention steady top-line growth. I know top-line growth refers to revenue, but what's the strategic significance of this, especially for Capital One?
Well, Capital One has been really focusing on those premium travel rewards cards.
Right.
And that segment has been performing very well lately.
It seems like that makes sense.
So this strong revenue growth that they're seeing is likely driven by that. It suggests they're attracting new customers, or maybe even encouraging existing customers to spend more. And this aligns with their goal of being a major player in that rewards card market.
Interesting. It sounds like they're doubling down on what's working.
Yeah.
Another detail that caught my eye is the increase in auto loans. Does this signal growing consumer confidence? Are people feeling good enough about the economy to make big purchases?
Yeah, that's definitely a possible interpretation. If we connect this to the bigger picture, these rising auto loan volumes could really reflect a broader trend of consumer optimism,
Yeah.
A willingness to take on debt.
Okay, but on the other hand, the report also mentions an increase in the provision for credit losses.
Right.
And that sounds a little bit concerning. Are they anticipating more people defaulting on their loans?
It's not necessarily a red flag, but it's something we should pay attention to. This provision is basically an estimate of potential losses from loans that might go bad. So an increase doesn't always mean things are going downhill. It could just reflect that Capital One is being careful with risk management.
They're being cautious.
Yeah, considering all the potential economic headwinds we might face, they're setting aside more money to cover potential losses, which is pretty standard practice for financial institutions.
That makes sense. It's like putting on extra armor, just in case.
Yeah.
All right, so let's talk about the big news, the planned acquisition of Discover. Shareholder votes are scheduled for February 18th, and this move has the potential to really shake things up in the financial world.
Yeah, it definitely does.
What are the main takeaways from this acquisition, both for Capital One and for consumers like you and me?
Well, this acquisition is a total game changer for Capital One.
Oh, wow.
It would really expand their market share, possibly even making them even more dominant in the credit card world.
Yeah.
For consumers, it's kind of a mixed bag.
Okay, so what are some of the potential benefits and risks for consumers then?
Well, a bigger Capital One could lead to more competition, which could result in better products and rewards to attract and keep customers.
Right.
But it's also important to remember that these mergers and acquisitions can sometimes lead to less consumer-friendly outcomes.
Oh, how so?
There's always the risk that a merged company could become too powerful. And that could potentially mean higher fees or terms that aren't as good for consumers.
So there's a lot at stake with this acquisition for everyone involved. But before we get too deep into the impact of this potential merger, there's another really important piece of the puzzle.
Oh, what's that?
The press release mentions that Capital One is working closely with regulators on this Discover acquisition.
Right.
What does that mean in practice? And what kind of power do regulators have to actually influence a deal like this?
That's a really crucial question, and it gets to the heart of how the financial industry works. Regulators have this really important role. They make sure that everything's fair, that consumers are protected, and that the financial system as a whole remains stable.
Okay, so they're like the referees.
Exactly. They're making sure everyone's following the rules and that the playing field is level.
So in the case of this mega merger between Capital One and Discover, what are the regulators looking for?
Well, they want to make sure that this acquisition won't create an entity that's too big to fail. Something that could pose a risk to the entire system.
Right.
They'll be looking at the deal from all angles, checking for any red flags that could raise concerns about things like market concentration, consumer protection, data privacy, or even the overall stability of the whole financial sector.
And what kind of power do they actually have? Could they stop the acquisition if they find something they're not happy with?
They absolutely can intervene. Regulators can say yes, no, or even impose certain conditions on mergers and acquisitions in the financial industry.
Wow, so they have a lot of authority.
They really do. They can demand changes to how the deal is structured, require the companies to sell off certain assets, or even block the merger completely if they think it's not in the public interest.
So this adds a whole other layer of complexity to this whole process.
Absolutely. And it shows the balancing act companies like Capital One have to manage. They want to grow, but they also have to navigate this complex world of regulations. And they need to show they're committed to operating responsibly.
It's like a high-stakes game of chess where every move has consequences.
Exactly.
But before we lose ourselves in the world of regulators and mega mergers, let's go back to Capital One's financial performance and see if there are any other interesting details in these documents. What else stands out to you?
There's one item that I find really interesting. It's the mention of accelerated philanthropy contributions in their income statement. It looks like they made a pretty big donation this quarter.
That's not something you usually see highlighted in an earnings report. What are the possible interpretations here?
Yeah, it is unusual.
Are they just being altruistic, or could there be a strategic element to this public display of generosity?
It's tough to say for sure without more information. It could be a genuine desire to give back, which is great. But it's also possible they're trying to improve their public image and show their commitment to social responsibility.
It makes sense, especially with all the attention they're getting with this Discover acquisition.
Yeah.
It's like they're saying, hey, we're not just about profits. We care about giving back, too.
Exactly. It's all part of managing how people see them and building trust.
Okay, here's another detail that caught my eye, the breakdown of their loan portfolio. It looks like commercial and multifamily real estate loans dipped a bit this quarter. What could that tell us about the current state of business lending?
Well, this decrease actually lines up with what we've been seeing in the real estate market generally.
Okay.
Rising interest rates and all the economic uncertainty have made investors and developers more hesitant. It seems like Capital One is reflecting that caution in their lending practices.
So they're basically saying, we're still lending, but we're going to be extra careful about where we put our money.
Exactly. Being more selective in a market that could be volatile is a smart move.
And speaking of strategy, the report also mentions their ongoing investments in technology and digital innovation.
Yeah.
In today's rapidly evolving financial world, what's the strategic significance of these investments for a company like Capital One?
Technology and finance isn't just a tool anymore. It's really what drives innovation and competitiveness. Capital One is investing heavily in things like mobile banking, artificial intelligence, and data analytics. This helps them improve customer experience, streamline operations, and stay ahead of the curve in a market that's constantly changing.
So they're trying to stay ahead of the game, using technology to prepare for the future.
Exactly. They know that to remain a leader in the financial industry, they have to constantly innovate and adapt to the changing needs and expectations of their customers.
Which makes sense. In today's world, if you're not innovating, you're falling behind. So before we wrap up this first part of our deep dive, let's zoom in on Capital One's credit card operations. The financial supplement gives a detailed look at this segment, and I'm really interested in unpacking those details to see what we can learn.
Sure, let's take a look.
What are some of the key things that jump out to you?
Well, one of the most interesting things about their credit card business is this balance they're striking between growth and risk management. They're seeing that steady top-line growth we talked about, but they're also increasing their provision for credit losses. That suggests a cautious approach to how they're managing their portfolio.
So they're trying to capitalize on the growth opportunities in the credit card market, but they're also keeping an eye on those potential economic headwinds and the risks of lending.
Exactly. It's a delicate balancing act that requires understanding both the market and how the creditworthiness of their customer base is changing.
They need to find that sweet spot between maximizing profit and minimizing risk.
Absolutely. And it's a challenge that keeps evolving as economic conditions and consumer behavior change.
Well, we've covered a lot of ground in this first part of our deep dive. We've looked at Capital One's overall financial performance, their big acquisition plans, the role of regulators, and even their philanthropic activities. But we've just scratched the surface of their credit card operations.
Right?
In the next part, we'll dive deeper into that segment, analyze the specific trends and challenges they're facing, and what it all means for consumers like you. So stay tuned for part 2, where we'll continue to unpack the complexities of Capital One's business, and we'll look at the broader forces shaping the financial industry.
Looking forward to it. All right, so let's get back to that fascinating world of Capital One's credit card segment.
Yeah, I'm ready to dig deeper into that. The financial supplement breaks down how their different credit card products are performing, and one thing that really pops out is that strong growth in their rewards cards.
Yeah. And what's really interesting is that Capital One seems to be doubling down on a strategy that's working.
What do you mean?
They're putting a lot of emphasis on those premium travel rewards cards. That segment has been really lucrative in recent years.
Makes sense given how much people want to travel after the pandemic.
Right. People are ready to get back out there and see the world, and they're willing to pay for those premium perks and rewards that make their travel experiences even better.
Yeah, definitely. So Capital One is being smart about capitalizing on that trend. They're offering those tempting sign-up bonuses, generous rewards programs, and travel benefits that appeal to a certain kind of consumer, those who have the money to spend.
Exactly. They're targeting those affluent consumers who are looking for those extra perks.
But it's not all about attracting new customers, is it? They also need to keep their existing cardholders engaged and spending.
Oh, absolutely. Capital One has been very strategic about that.
That's also.
They're constantly innovating those rewards programs. They're partnering with popular travel brands, and they're using data analytics to personalize offers and recommendations for each individual cardholder.
It's like they're creating this whole travel ecosystem, making it super easy and rewarding to use their Capital One cards for everything travel-related.
Exactly. It's not just about the card itself. It's about providing a whole curated travel experience that builds loyalty and keeps people coming back for more.
Smart. Now, while their focus on rewards cards is clearly working well for them, the report also mentions that increase in the provision for credit losses in that segment.
Right.
What's behind that? Is it a warning sign or just them being cautious?
It's important to remember that the credit card industry is always kind of up and down. As the economy changes, so does the ability of borrowers to repay their debts. So an increase in that provision for credit losses doesn't necessarily mean things are going to go bad. It could just mean that Capital One is being proactive and managing risk, making sure they're ready for any potential bumps in the economy.
So it's like they're getting ready just in case a storm hits.
Exactly. They know the economic outlook isn't totally clear, and they're adjusting their risk management strategies accordingly. That's a smart move, especially with the possibility of rising interest rates and inflation affecting how much people spend and their ability to pay back what they owe.
Now, another thing that caught my eye is the breakdown of their credit card portfolio by type. It seems like a big chunk of their loans are in that super prime category.
Yeah, that's a really important point. Super prime borrowers usually have those excellent credit scores and a really solid history of managing their credit responsibly. They're less risky for lenders, but all the competitors want them to.
So Capital One really needs to offer competitive products and rewards to keep those high-value customers happy.
Exactly. It's a constant battle in that segment to get and keep those prime borrowers. And Capital One is definitely focused on appealing to them.
All right, let's switch gears a bit and talk about that planned acquisition of Discover again. It's a bold move with some big consequences, and I'm really interested in exploring the potential benefits and risks, both for Capital One and for consumers like us.
For sure. Well, from Capital One's perspective, this acquisition is all about growth and becoming even more powerful in the market.
Okay.
By getting Discover, they would massively increase their customer base, get into new markets and technologies, and potentially become an even bigger force in the credit card world.
Like they're building a financial empire.
Exactly. They're thinking long-term and positioning themselves for growth and bigger profits down the line.
But, as we talked about earlier, these mergers and acquisitions can be tricky. There are potential benefits for consumers, like more competition and new innovations. But there are also some risks to think about.
Right. One of the biggest worries is that it could actually reduce competition. If this merger creates one company that's way too powerful, it could really hurt innovation.
And consumers could end up with worse options and deals.
Exactly. It's like that saying, too much of a good thing can be a bad thing. If one company gets too much power, they can kind of control the market and leave consumers with fewer choices.
Another worry is what could happen to customer service. When two big companies like this come together, it can cause a lot of disruption and mess things up as they try to combine their systems and how they do things. That can make customer service worse, which is frustrating, and can cost consumers money.
Yeah, sometimes bigger isn't always better. That added size and complexity can create a lot of bureaucratic headaches, and you lose that personal touch that a lot of customers value.
Another potential downside is the risk of job losses. When companies merge, there's often overlap in different departments and roles, which can lead to layoffs. This is always a sensitive issue.
Yeah, it is.
It's important to remember the people who could be affected by these corporate mergers. While they might create new opportunities in the long run, there can be some real pain and uncertainty for employees in the short term.
And it's important to note that regulators are very aware of all these potential risks. They're going to be looking very closely at the Capital One Discover merger to make sure it doesn't hurt competition or create unnecessary risks for consumers.
So it's not a done deal. Regulators actually have the power to stop or change the merger if they think it's necessary.
Absolutely. Regulators play a huge role in protecting the interests of consumers and making sure the financial system stays healthy.
Okay.
They have a lot of tools they can use. They can demand that the companies sell off certain parts of their businesses, set conditions for the merger, or even completely block the deal if they think it would be bad for the public.
That's good to know. It's important to have someone watching out to make sure these mergers don't hurt consumers or the whole financial system.
Right. And while all of this is going on with the regulators, it's important for consumers to stay informed and really understand what this merger could mean. If it goes through, it could change things like your credit card terms, rewards programs, and even what products are available.
So it's like a chain reaction.
Yeah.
One event can trigger a bunch of changes across the whole industry.
Exactly. Consumers need to be aware of these potential changes so they can make good decisions about their money.
Okay, let's shift back to Capital One's financial performance and see if there's anything else we haven't talked about yet.
One thing worth mentioning is their investment in technology.
Yeah.
Capital One has been leading the way in digital innovation and finance, and they're still putting a lot of money into things like mobile banking, artificial intelligence, and data analytics.
Why is that such a big priority for them? Is it just about keeping up with the competition, or is there a bigger strategy behind all of this?
It's definitely more than just keeping up with the latest trends. For Capital One, technology is a really important part of their overall strategy.
Okay.
It helps them improve the experience for customers, make their operations more efficient, and gain an advantage in a market that's changing all the time.
So they're using technology to create a more efficient, customer-focused, and ultimately more profitable business.
Precisely. They recognize that in today's world, consumers expect things to be seamless and personalized. And they're using technology to meet those expectations.
Like they're building a bridge between their products and services and what their customers want and need.
Right. And they're using all that data and analytics to better understand their customers' behavior and preferences.
So they can tailor their offers and marketing more effectively.
Exactly. It's a really cool example of how technology is changing the whole financial industry.
Hmm.
Those lines between traditional banking and these cutting-edge digital experiences are getting blurred.
Now, even though Capital One is doing well with digital innovation, they're also facing challenges in other parts of their business, like the increasing competition in the credit card market. With so many companies fighting for customers, how is Capital One setting themselves apart and staying ahead?
They're using a few different strategies. They're focusing on specific niche markets, developing new and innovative products and rewards programs, and leveraging their strong brand recognition.
It's like they're playing a very strategic game, constantly adapting to outsmart their competitors and capture more of the market.
Exactly. They're not just sitting back. They're always pushing the limits and trying new things in the credit card world.
So we've covered a lot in this part of our deep dive. We talked about Capital One's credit card business, their plans to acquire Discover, what role regulators play, and the challenges and opportunities they're facing in this fast-changing market.
Right.
But there's one more piece of their business we haven't explored yet, their commercial banking operations.
Yeah, that's a really important part of their business, and it gives us some valuable insight into how Capital One is handling the tricky world of lending to businesses.
Okay.
In the next part, we're going to take a closer look at their commercial banking division. We'll analyze their loans, their risk management strategies, and the overall health of that part of their business.
Sounds good. All right, let's focus on Capital One's commercial banking division.
This is a really interesting area. It gives us a look into how they're handling that world of business lending, which can be pretty complex.
The financial supplement breaks down their commercial loan portfolio in detail, and I'm struck by how diverse their lending activities are.
Right. They're not putting all their money in one place. They're lending to all sorts of industries, from real estate and construction to healthcare and even technology. That helps them manage risk because they're not overly exposed to any single part of the economy.
It's kind of like building a balanced investment portfolio.
Yeah.
But instead of stocks and bonds, they're investing in businesses.
Yeah, that's a great way to think about it. Just like with a diversified investment portfolio, spreading their loans across different industries helps protect them if one area starts to struggle.
One area I'm especially curious about is their exposure to commercial real estate.
Hmm.
Given all the ups and downs in that market lately, how are they managing the risk there?
The report really emphasizes their cautious approach to commercial real estate lending. They're being very picky about what projects they finance, focusing on high-quality properties in markets that are known for stability.
Okay.
And they're keeping a close eye on the loans they've already made, looking for any early signs of trouble.
So they're playing it safe, trying to protect their investments in a market that could be risky.
Exactly. It's not just about chasing the highest returns. They're prioritizing managing risk and making sure they don't lose money.
Now, something else I find really interesting about commercial banking is the relationship between the bank and the businesses they lend to. It's more than just handing over money. It's about building partnerships that last.
Absolutely. Capital One talks a lot about the importance of really understanding their clients' businesses and working closely with them to come up with financial solutions that fit their specific needs. They're not just a lender, they're like a trusted advisor, helping their clients navigate the challenges of running a business.
So they're taking a more holistic view, recognizing that their own success is tied to the success of the businesses they work with.
Exactly. It's a win-win where everyone benefits.
Now, we've talked a lot about the challenges Capital One is facing, like more competition and all the changes in regulations. How are these challenges affecting their commercial banking operations?
Well, one of the toughest challenges is the pressure to stay profitable when interest rates are so low. That's especially hard in commercial lending, where profit margins are already pretty small. Capital One is trying to deal with this by focusing on being more efficient. They're using technology to streamline their operations and reduce costs.
So it's all about doing more with less, finding ways to improve processes and make the most of their resources.
Exactly. They're embracing innovation and coming up with creative ways to provide value to their clients while still making sure the business is healthy.
Okay, so before we wrap up our deep dives into Capital One's performance, let's take a step back and look at the bigger picture. What have we learned from analyzing these earnings reports? What can they tell us about the overall economy and the future of the financial industry?
I think one of the main takeaways is that the economy is still recovering, but it's a bumpy road. Some sectors are doing great, while others are still struggling.
Right.
Capital One's diverse loan portfolio shows this. They're seeing strong growth in some areas, but weakness in others.
It's a good reminder that we're not completely out of the woods yet. The pandemic is still having an impact on the economy, creating both opportunities and challenges for businesses and financial institutions.
Another key insight is that the financial industry is changing rapidly. Technology is advancing, consumers have new expectations, and regulations are getting stricter.
That's a lot to keep up with.
It really is. Capital One's strategies, like their investments in technology and their focus on managing risk, show how they're adapting to this constantly changing landscape.
It's like they're navigating a really complicated maze, making adjustments along the way to avoid obstacles and take advantage of new trends.
Exactly. And their success is going to depend on how well they can anticipate and respond to these challenges.
Well, we've covered a lot of ground in our deep dive into Capital One's fourth quarter 2024 earnings. We've looked at their financial performance, their strategies, the challenges they're up against, and the bigger economic picture. I hope this has given you a better understanding of Capital One and the factors influencing the financial industry. Thanks for joining us on the Daily Earnings Reports podcast. Be sure to tune in next time for another deep dive into the world of earnings. Until then, keep learning, keep exploring, and keep our podcast in your feed for more insightful analysis.